Good morning. Thank you for joining us for today's webinar, our coffee talk, where we'll discuss finding profitable loan growth in 2025. My name is Sean O'Brien, president of QuickRate, and I'm pleased to be joined today by Tim Keith, CEO of Infusion Marketing, and Dan Marks, president of Infusion Marketing Group. So they're going to handle the majority of the presentation today, but just a couple of housekeeping items before we get started. One, we're in presentation mode, so hopefully you can hear us. Please use the Q&A and chat feature to submit any questions throughout the discussion. We'd love for you to, interject with questions that you might have as we go through. We will take those at an appropriate pause or break in the discussion, or certainly towards the end of the presentation today as well. As per usual, we will start with a couple of polling questions. Appreciate your feedback or participation in these. So I'm going to go ahead and get those started. The first one is around loan balances. What did loan balances grow in 2024 for your financial institution? What percentage did your loan balances grow? We missed that. So we'll just give this 30 or 45 seconds to respond, and then we'll ask a second one. But again, appreciate everyone's participation. Okay, we'll go ahead and share those results. So 33% of you were between 5 and 10%. 25% of you were less than did have no loan growth. 17 between 0 and 2 and greater than 10, and then 8% at 2 to 5%. So appreciate those responses. Let's go back and we'll ask the second question here. Whoops. Regarding growth priorities. So this is a little bit different. We're asking you to rank 1 through 6 your top loan growth priorities for 2025. And so the choices are between balance growth, overall margin expansion, mix change, credit quality, economic profit growth, or product launches. So again, you can just at the bottom there, go ahead and line those up. So we'll just go their numbers, but alphabetical order there. Okay, we'll go ahead and end that one. Not sure how this will share. Okay, so that one's a tough one to display visually, but in our recap to you next week, we will send out a email with the results of the survey. We'll also include a link to the presentation itself and a copy of the slides. So look for those early next week. And again, thank you all very much for attending here this morning. At this point, I'm going to turn the presentation over to Dan, and Dan's going to get us started.
Yeah, hey, thanks, Sean. And so we just a little bit of a reminder what Sean said is, chat your questions. We'd love to make this interactive. And the fun thing about the coffee talks as we started working with Sean and the team is they're just, we love how interactive they are. And so this is a dialogue. Great to see some of your priorities. We'll make sure we kind of tailor the conversation where you're going. If you have thoughts as well through that, we can. So, we thought probably one of the first places to start is if you're new to understanding Infusion's perspective. So Tim, you want to give kind of a highlight of Infusion's perspective and expertise?
Sure. Infusion's been around 17 years as of last month. We work with community financial institutions all across the country. We are performance-based in terms of how we are compensated by clients. And so we are in the same boat with clients. We succeed when clients succeed. We're data driven, and machine learning really drives the analytics and ability to effectively target uh, our different campaign efforts for clients. And probably the best thing I can say about that is we just went over 20 billion in deposits and loans generated for our community financial institution partners, all that on a performance-based model. And that's just a very large number of base hits adding up into what would be a pretty good sized regional bank, just in the results that we've been able to generate. When I say machine learning, we take in data, core data every day from banks all around the country, credit unions, and the machine turns that into a continually evolving set of intelligence on how consumers and businesses are using banking products, how they're responding to various value propositions that are being presented to them in a range of different types of channels. So I think when it comes to lending, there are cycles where that are just conducive to a more value-based lending. So rates are good. So you're going to get a lot of refinance and in terms of both business loans and mortgage. Then there are other cycles like the one we're in now that are not that, where you've got to be more scientific, more disciplined, more focused to be able to grow. But the good news is there's really predictive data in every one of your customer files that can help us, if we commit to a discipline, to be able to find quality loan growth opportunities that are rooted in relationships where we're not having to compete down to the basis points on price. And when we're successful, we're not only getting quality growth, but we are getting retention benefits in relationships. And that's really at the heart of what Infusion's all about, is relational orientation. The last thing I'll say is Infusion is led by a team of strategists who have sat in your chair. I think we have been senior VP or higher level at something like 16 different institutions, just like yours. So we've lived firsthand the challenges you have, limits of your core operating systems, the compliance issues you deal with every day, we dealt with as well. So we're not going to recommend things to clients that you're not going to be allowed to do, or that your systems are not going to be able to support. Because we've been there and done that. So that's kind of Infusion in a nutshell.
Yeah, and then so then, as Tim talked about, we're very accountable. So the perspective is we have big picture, which we'll actually share some of those in a minute in this context. But then when we think about the tangible KPI impact we're having with clients, we've worked with clients to increase their new to bank household generation, basically almost double it over a period of time. So 79% increase documented, specifically tracked. We've seen results for clients who we worked with on it's a little bit of an optimization journey, but we've had multiple situations where we've seen a delivered effective CPA of $42 on a pay performance basis. We've seen it's very common for clients to see a 2-month payback on campaigns. In other words, they're already generating contribution and enough loan volume or deposit volume or fee, combination of fee and spread income to be seeing a basically a payback by the time they get the invoice at the end of a quarterly campaign. And so and then of course the balance sheet perspective that Tim was talking about, 63 basis points better cost of funds on one example of helping clients use data and targeting to drive not just volume, but margin improvement, depending on a priority. And so, we don't really want to make this a sale. We felt that perspective on Infusion was helpful in part of this conversation. We thought it would be helpful to share really 3 key topical areas in this conversation. One is go through quickly just what big picture loan trends. So we're gonna talk about some macro elements. Sean's going to cover a chart out of Quick Analytics that has complete call report data on banks and credit unions out there. We're going to talk about some trends in actual response rate, booked account response rate by different segments. But we're going to spend most of the time looking at some case studies on what a data-driven growth process looks like to have a sustainable, repeatable foundation to identify and then monetize those loan opportunities, and then case studies. So, okay, let's talk about process, but then also the output of that process we've seen, and talk about the difference of those drivers. Sean, I think you're on mute.
Yep. There we go. Yeah. So, again, I think as we, go head into the year, we had been seeing over the last couple of years, still loan growth across the industry, but it certainly had been decelerating. I think, as is often the case, we started to see things start to barbell a little bit, but this was an area where surprisingly, maybe not surprisingly, but over the last 12 months, right, we really saw banks between 250 and $1 billion, outperform the $1 to $10 billion banks. The $0 to $100 million banks have, kind of consistently struggled to, find loan growth over the last 12 months. But again, still pretty respectable across the board, which is certainly an encouraging sign as we head into 2025. And again, I think while still there were 17% of the banks in the country who saw no loan growth, I think everyone's expectations is that this coming year will be better. I know we had a comment in the chat about potentially how regional trends might influence, loan opportunities, housing market CRE or small business growth. I think that will remain to be seen. I think there's certain areas, that have, again, traditionally outperformed in those areas, i.e. the Southeast and Southwest. We'll see if that, what impact, for instance, obviously the wildfires in California have, and the hurricanes been in Florida, what kind of impact we'll continue to see. I think small business growth has still been good, but muted. So I think it'll be a lot of interesting things to follow as we go into 2025. But I think again, I think from an optimism point of view, I think banks of all sizes are more optimistic this year going into finding growth than they were, say, 12 months ago. Dan?
Yeah. Yeah, and Tim and I are going to go back and forth on a lot of the content, but it's very helpful to have Sean, you set that stage. So, there's the big picture when it comes to actually doing granular, primarily small business and consumer targeted growth. We see, one of the things we track is what's the actual booked account response rate related to targeted marketing and sales efforts, and we do this for campaigns we execute. We also have part of this information is clients that work with us on tracking only without execution. So it's a really robust data set to understand industry trends, and then we can cut it up by segments and those kind of things. But just from a high level perspective. Interestingly enough, credit unions tend to outperform bank on response rate. Some of that reflects more of that historical pricing posture, and then a little bit more focus on installment versus business or home equity or homeowner secured. But what we're seeing is that we're coming out of a dip. As rates started rising, that definitely suppressed response rates as a measure of demand from both credit unions and the banks on the right side. But it's coming back, and so we would say both the credit union and bank response rate from the most recent quarters that we have available are right in line with a long-term norm. Long-term average. And so that's a great indicator of, if you think about, if your priority is to grow, there are opportunities out there from a demand perspective, even at the current rate environment. And if we get a couple more rate cuts into next year, that will certainly help be a tailwind on demand. But the key takeaway from this chart is we don't even need another 2 rate cuts to have a nice amount of demand if you know where to go get it. What's different is, so credit unions tend to have a higher response rate for consumer and small business loan, and credit unions really don't do much small business at all, although that is increasing. Banks certainly have a much higher, in fact, double or more average balance of responders, and so that reflects both a different product mix, but also a different capacity of the borrower. And so that's a, you know, it's a key point to think about, not just quantity but quality on both dimensions, and when we track both very carefully. So, Tim, anything to add on that point?
Now you got it.
And so one of the points that we say when the topic is finding profitable loan growth, and so we love to hear. And so when you talked about the priorities on those poll questions of balances or volume and margin, and a little bit of comments on pricing, what certainly we know if you do a rate that is better than anything else in the market, and you put it on billboards, you'll attract a lot of volume. But that does not factor in the relational context that Tim was talking about earlier. You know, it will not help build relationships, and it will not help drive the right kind of quality in terms of credit quality or margin and those kind of things. And so one of the things that we've observed from all the different banks we've worked at ourselves, or credit unions, and work with clients, is creating a predictable, profitable, organic loan growth engine. So not buying loans, whether or not you're actually buying buckets of loans or you're buying it with rate, is possible with the right discipline. And so what does that discipline look like? It's a continuous improvement do loop in terms of having a regular systematic assessment of opportunity. And so again, when we were sitting in as bankers chairs, we love tapping into outside expertise, because even if you have a very robust data analysis shop internally, that perspective is only the internal perspective. And so drawing upon an external perspective, a perspective that pulls from, you know, hundreds of different institutions, is just a richer insight of identifying those opportunities, feeding into specific planning and prioritization, guided by data, guided by pro formas of what the actual results could be in terms of trade-offs, and then running tactics, running focus campaigns that can consist of pure marketing, air cover, lead generation, feeding into the sales team, or it can be supplemented with, you know, particularly on the business side, air cover coupled with targeted outreach list for the bankers to follow up on those, and continuously improving. So not just sort of random acts of marketing where you toss something against the wall or do these big, like I mentioned, you know, putting a big rate or a market leading rate on a billboard is kind of the spray and pray approach. As predictable is targeted, tracked, and continuously improving based on that refinement. So that's our perspective on what a disciplined process looks like. When we think about assessing opportunity, there's a whole set of strategic questions that we look at with clients. But some of the buckets that those wrap up into include how penetrated for credit needs are my existing customers, right? Every bank or credit union we've looked at, so I'm not saying it doesn't exist, but everyone we've seen so far always has attractive growth opportunities within the current book that can be mined as a starting point. And the advantage of starting with customers is you build that relationship. You also have a lot more information about them. And so using that as a foundation before you consider going out to prospects is essential. And then number two is, so what are the high potential, high quality opportunities? What are the lower potential? So there might be certain things even among customers or prospects that are prioritized opportunities that have a mindful of credit risk. So current customers, you have much more intelligence on those. And so what does it suggest for high priority growth? And then of course, a third key question that's on a lot of mind is what am I doing to proactively, specifically do outreach to underserved areas? Obviously, the regulators are very, very as interested in ever about that. And there's a lot of opportunities to apply data to be very specific and collect tangible metrics on what those outreach efforts are doing to generate awareness and take historically underserved borrowers down a buying journey. So, Tim, I think you're going to cover the next couple slides, right?
Yeah. So this slide is kind of just foundational in terms of what you'll see on the next few slides is in terms of how to look at data. And we start with this really simple premise that any sales process, including the process of selling loans, to be successful, that you've got two things are required. The person you're selling to must have the means to buy the product and at least some inclination to buy the product. And so this is something you deal with in your environments every day, because all of you have potential borrowers who badly need credit. So I have a high propensity to borrow, but if I have no capacity, if my FICO is 580, you can't make me a loan, because notwithstanding all of my propensity, I have no capacity. On the flip side, all of you also have potential borrowers with tremendous capacity to borrow. So they have perfect credit. They own their homes outright. They could borrow substantial amounts of money from you, but they have absolutely no need for credit. And so that capacity does you no good, because the lack of propensity stands in the way of making that sale or making that loan. So the whole lending process every day is an exercise in bringing together the relative capacity of a borrower to borrow in a particular category with their in-market status or their propensity to borrow. And so there are capacity and propensity indicators all through your customer files that predict these things. Some of those are institutional. They've demonstrated that they really like you a lot. They trust you. Some of those are category specific. They've indicated that they prefer to bank in certain categories or certain ways. And so when we start to put together these capacity propensity indicators, as we'll illustrate on some data tables on the next few slides, how you can identify discrete populations at points in time where you've got this intersection of capacity propensity, where good chance I'm going to be able to approve them and that they're going to be interested in what I have to offer. And then that starts that process Dan talked about, where we can then put our offers out there, measure what happens, then adjust based on what we learn. So I've presented this slide for 20 years, maybe even longer, in various conferences and so forth. And up until the last 4 or 5 years ago, all I had on the left was capacity propensity. But I've added awareness, because our business has become a digital business. Banking is a digital business, as you guys know now. So you may have a customer who's good credit risk. They generally think favorably of you, and they're in the market, let's say, for a home improvement loan. But the first thing they do is go to Google and do a search and find an online provider that is low friction and well priced. And we never get a shot at the business, because of, even though we have a vague awareness in their mind, we don't have a solution-based awareness. So if we're not out there proactively creating awareness of what we have to offer in these high capacity, high propensity segments, we are going to miss opportunities to make loans to customers that would be quality asset growth. And that's just a fact. Customers aren't coming to branches anymore. They're not sitting across the table from bankers, where we learn that, oh, you have a credit need. And of course, it's harder than ever to get a customer on the phone. So what you're going to hear, in the rest of this presentation is proactive awareness building allows you to take advantage of these highly predictive capacity and propensity indicators in your data files. And ultimately, these circles on the right basically represent our sources of income. We buy deposits from depositors, sell loans to borrowers, generate fees from transactors. And when we can meet multiple needs in a relationship, that's the overlap of those circles. And when you get a customer in the center of those three circles where you're meeting their credit need, their transactional needs, and their savings needs, your retention rates are virtually 100%. Your price pressure is significantly reduced because the reason they're with you is not 25 basis points difference on a loan. It's relationship, it's trust, it's history. And so in the process of meeting these wider range of needs through this continual awareness building, we're also migrating relationships into deeper and deeper categories that increase retention and sustain profitability over the long haul. So one of the things we do at Infusion that is super helpful, even if you're able to access your core data in a way that serves up some KPIs, that you can look at, which a lot of clients struggle with just that part of it. But even if you can see your own data, contextualization is everything. If I know that 35% of my mortgage households have a checking with me, that's a great thing to know. It's important information. But is that good? Is that bad? Should it be higher? Should it, what do I do about it? So what we do with in our database environment built on more than 15 billion data points is take individual client data and benchmark it to their peers using an index of 100 is the norm. So this 100-yard line you see on the slide is the average bank or average credit union. And so any of these bars that are to the right of the 100-yard line, they're higher than norm in these categories. The left, they're lower than norm. And so just to pick the ones that are boxed here, HD plus AB is where you have a high deposit relationship and an active borrower relationship. So you can see it pointing to that circle over there where you've got, or actually it'd be here, this circle here. And so they're 30% below norm where they're meeting both the high deposit and the active borrower need. So that's a quantifiable gap. I can run a math calculation to say, if I could get that to norm, how many loans would that add within my high deposit relationships? And so if we go to the next slide, we'll show some other examples of this sort of thing. This is a deposit concentration table, which if you haven't seen your data this way, you've got to do this. It's a fundamental indicator of liquidity risk. And so what you have on the left here is 6 ranges of deposits from $1 to 250,000 plus. The number of relationships that have that level of deposits with the bank, the percentage of deposits they control, the percentage that have checking accounts, average checking balance, the percentage that are single service, the percentage that have credit with the institution. And then you have your indexes are interspersed throughout. And again, an index of 100 is equal to the norm. So if we just look from a concentration perspective at this top row, 2.4% of their depositors control 34.6% of deposits. And their index on the percentage of depositors in that bucket is 43% below norm. That means they have higher concentration because they have a much lower percentage of depositors in that segment. And then you can kind of go through and see, are they more or less likely to have a checking account with you? The good news for them is in these highest tiers, their indexes are above 100, so they have good penetration of checking accounts. But to get back to lending, if we go over here, percentage of households with credit, you can see, first of all, their indexes here are below norm. So their depositors are less likely to have credit in every single deposit tier. And again, those are quantifiable gaps. In each one of these tiers, I can run a math calculation to say, if I could just get my percentage of households in these deposit levels to have a normal level of credit usage, what would that add to my balance sheet and assets? And by the way, when you look at these checking balances, 80,000, 43,000, 26,000, 11,000, if you do a home equity for households in these tiers, you're going to get quality assets. They're not going to miss payments on their home equity line. Their checking balance tells you they have good credit quality. And they're actively using a checking account, so they're using your debit card every week. So they're seeing your brand on that card. They're in your mobile app. Those are propensity indicators because they're engaged with your brand actively. So that means they're going to be receptive to messages you send them about meeting their lending needs. So when you start to combine these capacity indicators as illustrated by the checking balance, and by the way, the amount of money that a consumer or business keeps in their checking account is maybe the most predictive financial metric of capacity, maybe outside of FICO score, that there is in terms of likelihood to be creditworthy and to have money somewhere else. And so we can leverage that capacity indicator combined with these propensity indicators, active transactional behaviors, brand engagement, so forth, to effectively target loan offers where we're going to get quality assets and we're going to get an acceptable cost per loan. Now, I just want to show you how predictive, and Dan, if you go back one more slide,
Oh, sorry.
I want to show there how predictive the deposit data is on this capacity propensity indicators. So look at this percentage of household with credit. In your $1 to 2,500 deposit tier, 5% of households have credit. Well, that jumps to 9% in the next tier, and that's a purely capacity indicator. If you've got less than $2,500 in deposits, the chances I can underwrite you are lower. All of a sudden that goes up in the next two tiers because I've got more capacity to borrow, but then you start to see it decline as my propensity to borrow declines. So you get this sweet spot where the deposit level tells you I've got the wherewithal to borrow, but I'm still someone who probably uses credit actively. And so again, this data is so predictable and so rich, and this is not, you're not having to touch credit bureau data to be able to identify these different target segments. This is all in your existing customer files. So Dan, we'll go to the next one now. Sorry.
Yeah, and so Terry, I think that's also a key point to your question earlier around loan opportunities. Certainly regional is going to affect some of these things. We found over and over, diving deep into the bank's customer base, there may be different mixes, but there's always these kind of opportunities that Tim's talking about to identify with customer behavioral analysis.
Yeah, and Dan and Tim, if I was just going to jump in, and again, I think it just goes to emphasize, Tim, you made a point of it, but if you're not seeing your data in this way, right, you really are putting yourself at a huge disadvantage, just to really to begin to conduct targeted digital campaigns if you don't specifically know who you're going to. Is I think Dan, you mentioned it, right? If you're just going to put out a campaign to your audience or just the geographical audience of your branches, you already have available to you this rich, treasure chest of data. It's really, whether it's yourself or, utilizing someone like Infusion to assist you in kind of getting your arms around it so that you can just make much more informed decisions about who to go after. And again, do they have the capacity and propensity to do something?
Yeah, just a real simple illustration of that on this slide. These are high deposit households. So these are households that have $10,000 or more in deposits with this particular institution. If you can see the average balance, third row down here, 42,562. That's our average checking account balance of households in the segment. So again, very strong capacity indicator. If you go down to home equity, only 1.7% of these households have a home equity with this institution. But the average balance is $82,000. So these are folks that have high property values. When they borrow, the capacity levels allow them to borrow larger chunks of money. So you get more earning assets, but you still have this credit quality indicators in the deposit data. So that 1.7% home equity penetration, if we go to the next slide, Dan, and we look at our gap analysis, you can see that cross-sell opportunity gap. It's behind your head, Dan. I don't know if everybody can see that, but there we go. So they got a 28% gap to norm on the percentage of high depositors that have a home equity with them. So again, here you've got a segment where you've got a quantifiable norm. And by the way, the norm is only the average bank or average credit union. You can see there's a lot of bars where they're way above norm, but that's a simple calculation you can make to say, if I could just get to where my average peer is, how much would that add to my home equity portfolio in high performing assets? And by the way, when I do a home equity for that $40,000 checking household, I put a multi-year anchor on that checking account balance in terms of retention. because they're not going to, I've just solidified that very profitable checking by making that loan. So anytime I can spend one marketing dollar and get high performing assets and at the same with the same dollar get prioritized retention benefits, I want to spend that dollar every day of the week. And I'd much rather do that than throw dollars out to non-customers who have low propensity to bank with me, and where I'm going to have to use price to make up for the lack of propensity. I want to make sure I'm closing these gaps first before I do that. Then the last thing here in terms of just some of the benchmarking, understanding how penetrated your credit households are with checking and how penetrated your existing credit households are with different types of credits is really important. And one of the really important metrics is checking penetration of mortgage households. Some institutions, when I worked at First Tennessee Bank, we struggled with this because we had a separate mortgage company and the lenders just would not refer checking accounts. They didn't want to do it. We couldn't get them to do it. So we were always below norm on that stat. The problem with that is a mortgage household that has a checking account with you is 2 to 3 times more likely to subsequently do a home equity on the same property. That checking is the bridge from the first mortgage to the second mortgage. And so good news for this institution here on the second bar on the right is their checking penetration of mortgage, which by the way is 47.6% over here on the left. That's 2% above norm. So they're doing a pretty good job there. And then you come down here to home equity percentage of mortgage and you see that correlation. They're 22% above norm for the percentage of their mortgage households that have a home equity. And so you see when I do well with checking penetration of mortgage, it carries over into home equity penetration of mortgage. And so the best place to focus on that is onboarding of new mortgage households. If you have a dedicated, systematic onboarding outreach to new mortgage households without checking to get them into checking, of course, we get good checking accounts, which is great, but then that creates a bridge to the second mortgage downstream from that. Now they have gaps in other categories here. Their home equity penetration of checking households is 24% below norm relatively speaking. Again, so that's a very targeted opportunity. When you go down here to direct installment loan, their direct loan penetration of checking households is 63% below norm. So these are quantifiable opportunities. We didn't show it on this particular slide, but we also have the same set of benchmarks for credit card. So some of the cells you want to look at are how am I penetrating my direct loan households with credit card, because their underwriting is similar. If I've underwritten them on a direct loan, I should be able to get a credit card in there. And the same thing in reverse. How if I penetrated my installment loan into my credit card base, because you should be able to be really effective because you've got demonstrated borrowing capacity through the fact that you've approved them already. And just to illustrate one more time the capacity propensity indicators, mining your mortgage base for home equity growth is a great illustration because you've got demonstrated capacity, you've approved them on the property before, and propensity. If you've approved that customer on that property before, their confidence level that you're going to take their application seriously on that second mortgage is higher. So that's a propensity indicator because you've already approved them once and they have that confidence factor. So very simple illustration again of these capacity propensity where you can find these different cells of actual households that I can build a campaign around and then communicate what I have to offer, and without having to use top of market rates to make that sale happen.
Yeah, so we've obviously spent a lot of time talking about what does this fundamental discipline look like? Because this is really, like we said, foundational. So when you think about finding profitable opportunities, it's applying this kind of discipline and analysis that Tim's talked about. And then the key part of it is identifying those opportunities, executing and tracking them very specifically. And so one of the things that we help clients with is track all the way down from a specific targeted campaign, whether that's business or consumer, all the way to what is this combination of messages and data targeting very specifically convert in terms of booked new loan accounts, funded balances, and then the overall relation effect that we talked about, all the way down, come from audience to impressions, clicks to booked accounts. So that's really essential. We help clients with dashboards to understand that impact on a campaign basis, trended. We do, what's also essential is understanding multi-channel. And so when we think about monetizing the opportunities that the data analysis reveals, it's one of the things that we've just learned is clients don't sit around waiting for us to come up with a big loan promotion to decide to borrow. They have a need. They want to expand the business, buy some equipment, remodel the house, send the kids to college, whatever. That need triggers the then antennas going up, entering the shopping process for lending. And so, but if we can systematically identify proactively ahead of the likely need which people will have needs for certain things and get ahead of it by generating this kind of relevant awareness that Tim was talking about, we jump ahead of the line. We get ahead of the trigger type approach, which is quick, but it's still reactive. And so that proactive, relevant approach and being in there. Big believers in doing pro formas. So knowing ahead of time what to expect based on proven success in current market conditions, comparing the revenue or contribution impact on spreads and fees to the cost of the marketing activity, projecting that ahead of time based on benchmarks, and then being able to track, how does the plan drivers relate to that ROI. If you're new to the idea of doing targeted, applying data to multi-channel digital treatments, this is using data to identify an audience and then putting messages that match the goals of the institution to the specific people at the business or the household that are likely to have that need. And so whether or not it's a home equity to a homeowner with capacity propensity, businesses, having branded treatment that's specific to the need and how that matches up to the need. And so if you put all these together, you put then the front end analysis, the targeted alignment, and then execution. The short story is this identifying those opportunities, then going after them is achievable very quickly. So the process we're talking about doesn't require putting in some new system. It requires some front end analysis, establishing a pretty light effort feed to be able to activate and then track results. So it's up and running pretty quickly, and then has tangible results. So here's an example. We're going to kind of go back and forth on highlights here, but in this case, the community bank wanted to drive additional balances. It was a comprehensive program, so it included building relationship based on multiple needs. Like Tim said, adding that if somebody doesn't have a checking account, adding the checking accounts tees up nicely loan opportunities down the road. So and then people have different needs at different times, but the lending impact is real. So whether or not it's SBA leading business lending solutions, homeowner solutions, or even non-homeowner comprehensive results. In this particular case, client saw $331 million in proven response balances that were largely loans. Halo balances are things besides. So if you promote loans, you pick up some checking accounts and other things as well. That's not counted as response. And then in this case, this is an example of $44 effective CPA because we're pay per performance, so then we pay for it. But there's a cap. In this particular, the client put in a cap in place, so they essentially collared it, which allowed the CPA to go even lower when we outperformed the pro forma. That's one example. Another example, totally different regions. So one of the questions was, how does this apply to different regions? This bank's up in the Northeast. similar size to the one we were just talking about. But in this case, we saw a full year impact of $268 million of booked balances. These are not app values or line amounts. This is booked volumes within the tracking window, which is particularly impressive given a home equity line, of course, is not going to have as much funded initially. And then here we saw a $76 effective CPA. So we didn't quite outperform as much as the previous one, but really still really, and that's what we talk about when you think about the and even this next example, which is a different size bank, so smaller bank, lower response value. So here we had a little higher effective CPA, but this one, they still had the loan amounts were higher with a business focus, and so still saw probably a 3 or 4 month payback on the campaign. Another case study here. So, and this one had you'll see a very much of a line focus. High number of response accounts, fairly low initial funding balances, but and this was again based on the objective. So a lot of emphasis on HELOCs and relationship line of credits to enhance those relationship with the clients. And so nice number of response accounts for them, $100 booked CPA. And so when you think about having a identified cost per account up front that can only get better if we exceed the pro forma and cap out, that can be very, very attractive to different needs. And so you can see on this, one of the key takeaways here is the case study. This was applicable to their needs. So different size banks have different needs, different points in times. And so those things can be tailored and drive tangible value at all different scales with all different brand objectives. We've gone through a couple, kind of hybrid and consumer examples. There's also plenty of examples of, business focus. So here, targeted business banking. The CPA is higher because the average balance per booked loan is much, much higher with a pure business program. But again, really nice response balances, and still $250 cost per account for a funded business loan is still a very high ROI, high payback opportunity. And we've gone through a lot of bank examples. A lot of great examples from the credit union world. So here's an example of a credit union who wanted to grow both earning assets among homeowners as well as non-homeowners. And so we applied the data to understand, who was a homeowner, and then applied the other capacity and propensity factors to identify the best candidates for homeowner type solutions like a HELOC. Advertising a indexed rate versus prime gave them a lot of flexibility if rates changed during the campaign cycle. And then for the non-homeowner, really led with a personal loan. So 875 as low as is still a good rate on a personal loan. And so here. This credit union has about 90,000 members. And we saw, in a full year, added $58 million in response balances based on their objectives, delivered a $114, effective CPA skewed towards the homeowner audience that had, higher capacity, higher average balances. So we've gone through, we went through those case studies pretty quick as just to give you a flavor of how finding the opportunities requires discipline and analysis. Can that be done very quickly? But then when we monetize them also rapidly, we're tracking tangible results and helping create profitable opportunities for banks and credit unions across the country. And so, whether or not, like Sean mentioned, source we would love to help current clients and future clients with this type of work, but we're big believers of whether or not you use us or take another approach, having that discipline of mining the customer base as a beginning, and then also understanding prospect opportunity, but really convincing yourself that you've maxed out the relationship expansion opportunities is before even thinking about prospects. You're going to get all the benefits that Tim talked about in terms of relationship growth, attrition mitigation, credit quality from having a richer impact on the relationship, and then a systematic discipline process to execute and track upon those opportunities is essential. Not only essential but possible, and people are doing it every day. And so we have a deposit webinar coming up in about a month. There's a link to register on this deck that'll come out in the email. But as we get to the end of our time here, we just want to say thank you so much for joining. I'll probably try to go over here so you can see the website. But yeah, we'd love to talk to you further, Tim or myself or anyone on the team. Trevor Knott, our head of business development, is on the line as well. And so just echo, thank you for the time today. Hopefully this was interesting. Let us know, if you have questions as I digest. Love to talk about that further. So, Tim, any closing words beyond that?
Again, thanks for the opportunity to share this information today, and hope everyone has a wonderful weekend.
Great. Yeah, just echoing what Tim and Dan said, right? We really want to encourage you, again, depending on where you are in this, kind of journey, as you start to map out 2025, the opportunity assessment, is an easy way to kind of get a look at your data. It's certainly something we'd offer. I think we did have one final question for those of you still with us. I want to just share one final question on our final thoughts. And it's really just kind of an open-ended, just what type of information would you like for us to present in 2025? Again, we want to be additive to your, educational wants and desires and things where you're looking for more information. So certainly if there's anything you want to suggest, we'd certainly welcome that. Okay. And we'll again make those part of the email that we get sent out next week. So thank you for participating in that.
Awesome. Thanks, everybody.
Thank you.
Thanks, everyone. Have a great weekend.